Okay, welcome back, everyone. Again, we're talking about inflation and what happens when we have inflationary times, and then we ask, well, what is the cause of inflation? A lot of folks say, well, it's demand pull, and what does that mean? It just means that consumers really like that product, and there's just a overall huge increase in demand for the product. All right, so we would call that demand pull inflation. A great example is, and again, the price of cocoa has gone up because of they experienced quite a drought, but a great example would be chocolate. We look at China, for instance. Now that China has been introducing more and more of a free market system into their economy, what's happening? Well, in China, all of a sudden we're seeing a middle class developing. All right, and we're not just talking a few folks. I mean, you're looking at China. You've got 1.4 billion people. That's a lot of people, and now we're starting to develop a middle class. And guess what? That middle class has a great taste for chocolate. They really like chocolate. So what has that done? This is a great example of demand pull. Demand is and again, we acknowledge the fact that yes, cocoa in terms of the supply has been cut back due to the drought, but even without the drought, there would have been demand pull on the price, pulling the price up, because all these people, across the board, want more chocolate. All right, and again, when you're dealing with 1.4 billion people, that's a very significant number. So that would be what you would consider demand pull. Then there's also what they call cost push. Now, cost push, we think of, all right, in terms of economy, just think, now if you are a producer, all right, what are we doing? Well, producers do what? Companies do what? They use input to make output, all right? And if your input goes up in price, typically it's going to, you get a fixed budget, you're going to end up making less. And we talked about, shifts of the supply curve. Well, and that's what happens. You've got this, we got that our good old supply curve, and here's the demand. Well, and this is what happened back in the 70s, and I talked about it a little bit before. We had two major hits from OPEC in terms of imported oil for our economy, and what it did was, unfortunately, oil is one of those commodities that cuts across the board in terms of business. It's not as if it's one small segment of the economy that's gone dramatically up in price. This one, pretty much across the board, companies were experiencing a big hit with their input. So what that does, basically, we're going from this level, we shifted all the way from here, we shift all the way to here, and so what has happened, the price naturally goes up, and this is exactly what we experienced from the double hit in oil. We experienced prices going up and the economy slowing down, which we talked about, stagflation, which we experienced back in 1980. All right, so that would be called cost push. But when we think of it, the third one that really does make sense is the increase in the money supply. Just a flat increase in the money supply. Okay, so let's take a look at this board here. And in your book, they talk about the equation of exchange, okay? Well, again, it's just basically saying we take the money in the economy, right? And again, we're talking about macroeconomics. We got the money in the economy times the velocity of the money, meaning how many times does the money turn over in a year? Is it sitting there? Or is it one transaction? Is it 2 or 3 or 4 transactions? My daughters could make this number be extremely high. Anyway, we got the money in the economy times the velocity of money is equal to the price level times real GDP, or in other words, price times quantity. But here we're talking about overall price times all the quantity of everything, so real GDP. All right, now this is saying that, hey, it might not even be, although cost push or demand pull could influence the price, the major reason for inflation might just be an increase in the money supply. All right, now also bear in mind the velocity of money can change, but even if we said just to, for an example, that let's say velocity of money stays the same, the key factor is the money in the economy. Okay, now why would a government increase their money supply? All right, well, you know, the Fed did it in 1920, 1929. The Federal Reserve, the central bank of the United States, increased the money supply something like $27, $28 billion. And that sounds like a lot of money today. Just think going back to the 1920s, to a 1920 economy, that was a huge amount of money. So why did they do that? Well, the Fed did it because there were so many new companies starting out in the 20s. You know, we think today that we've got a lot of new high-tech or new products that you know that are making our life so much better, and we do. But just think, going back to the 20s, we're not talking about an additional app or two on our smartphone. We're talking about actually having a phone or not having a phone. We're talking about having a phone, you know, going from not having a phone at all to having a phone in your home. All right, so we had telephones, we had electric irons. You know, people could iron their shirt with an electric iron. We had RCA, they had phonographs, they had records and record players, you know, which you go from not having one at all to having something in your house. That was a big deal, and there were a lot of these companies starting out. So the Fed was trying to support all these new companies, and quite frankly, it expanded the money supply, and unfortunately, it reversed course when it created bubbles because the money supply was growing so fast, and then it reversed course and tried to tighten up the money supply, and then Hoover, because they didn't have macroeconomics, tried to take all these measures to help the economy, and they were the wrong measures because they didn't have macroeconomics. Anyway, it was a situation where the Fed did do it, and it created bubbles all over. It created bubbles in the stock market, which everyone talks about, and that gets most of the press or most of the publicity, the big bubble in the stock market. But there were bubbles all over the economy. There were land bubbles in Florida, California, capital equipment bubbles. There were bubbles all over, and they did unfortunately pop. And then we took the wrong measures to help the economy and just made the economy worse. Okay, so why Germany in the 1920s did it? Well, just think, you know, World War I ends, and you lost, and then the Allies go to Germany and say, okay, now you're gonna, you know, not only gonna acknowledge that it was your fault, you're gonna pay for it. You're gonna pay for World War I. You've been fighting World War I for 4 years. You've already been pumping the money supply up, trying to keep the economy going during World War I. Now you're being asked or told you have to pay for it. So what are you going to do? Your economy certainly isn't in a position to pay for it. You can't tax the people. You can't tax your people enough, even close to being enough to pay for it. So what do? They start printing Reichsmarks, and they printed a lot of them. And they're going to say, all right, we'll pay you back. And they start printing up more and more. What happened? The money supply just ballooned. And unfortunately, it wiped out the savings of the middle class in Germany. And the economy was just, the problems that it created for that economy were huge. And a lot of economists will argue that was one of the reasons for the rise in Hitler, okay? Now Zimbabwe, wow, talk about increasing the rate. Now Zimbabwe, you gotta hand it to them. Here if we started printing money like mad, again, our money would look like this. Instead of printing up all the Reichsmarks, you got to hand it to Zimbabwe. In fact, I've got one. I've been looking around for it. It's a $100 trillion note. Okay. Now Zimbabwe, they printed up notes, but what they did, they just kept adding zeros to it. They experienced, this is almost impossible to imagine, they experienced almost 79.5 billion, 79.5 billion percent per month inflation in 2008. I mean, that is staggering. You can't even, I can't even get my mind around an inflation rate that high, okay? So what happens? Well, you start inflating the money supply. Well, we won't even go to that extreme. But what happens? It creates bubbles, okay? And unfortunately, sooner or later, those bubbles will pop. It goes back to we were talking about the inflation tax. Well, just think, why would a government print money? Well, if you're the president of the United States and everything was okay, and then your Secretary of Treasury comes to you and say, oh, we've got a $500 million hole that we kind of overlooked. We have to, we have a debt here we have to pay. Now, what are you going to do? You're going to, let's say it's an election year. You certainly aren't going to tax the people more. Are you going to cut back on spending? And we'll be talking about fiscal policy, government spending and taxing in the weeks to come. Well, again, you don't want to cut back on spending programs, and you certainly don't want to increase the taxes. So what are your options? You think, well, the Treasury Secretary says, well, we could issue, we could print up, basically printing up more money. The Treasury issues the debt. The Fed, as they say, monetizes it. You could print up, let's say you print up $500 million to pay for that debt, okay? Well, what happens? Well, what happens is you get out, you take care of the debt, which you're happy about. In the short term, at least, increasing the money supply is going to, perk up the economy. So at least in the short term, and you say, well, yeah, but if you increase the money supply, aren't we going to see inflation? Yeah, you probably will, but it's going to be down the line. It may not be for 9, 8, 9, 10 months from now. And guess what? Perhaps you're going to experience a 5% inflation. And again, we're just using round numbers. So you experience a 5% inflation. It's 8 or 9 or 10 months down the road, and you and I, as members of citizens of the United States, we don't know that you did it. We can't say, we can't pin it on you, the president. we just noticed that prices are up 5%, okay? So what happens is you end up paying the debt that you needed to, the economy, at least in the short term, picks up, and folks aren't gonna figure it out for many, many, many months from now, okay? But if the prices have gone up 5%, guess what? You and I are paying 5% more. So they call that, again, refer to it as an inflation tax. You didn't want to come up at first and increase the taxes because, after all, it's an election year, you want to get reelected. But by increasing the money supply and allowing the inflation rate to go up 5%, in effect, you are actually taxing everyone 5%, because whether we go to buy something and they say, oh, that there's a 5% additional tax on that, or when we go to buy something and it doesn't cost $1, it costs $1.05, we're still paying for it. So they call that an inflation tax. That's another thing. Inflation. Look at the dollar store. Now they have to change all their signs. They're no longer, that would be menu costs. No longer the dollar store. It's $1.25 store. My daughters are upset about that because they get a lot of great stuff from those stores. But anyway, there's another example. So governments would do that, increase the money supply, for a number of reasons. Pay off a debt. It does perk the economy up, at least in the short term, and folks aren't going to figure it out for a while. Now, granted, not to these extremes. These are the extremes that end up destroying an economy. Okay, so they have to be careful of going into hyperinflation. All right, bubbles typically bubbles occur. When you've got all this mania for a particular item. In the 1630s, the Dutch tulip bubble. 1990s, .com. In the 1990s, everybody was going to get rich. All you had to do was, come up with a business idea and put .com after it. Everything was going to be great, So we had this big .com bubble, okay? We had the housing bubble. 2000, 2006. We had banks writing mortgages to folks who couldn't pay for it. And we had this mania of, okay, I'll take that mortgage, and even if I can only afford the teaser period where they have that teaser rate, that really low teaser rate, it doesn't matter, because I'm going to turn around and sell it at a huge profit anyway before that first, whatever it is, 9 months or 12 months before that time period runs out. Okay, so all these things can cause bubbles. They're very disruptive, obviously, to an economy, and that can really, in the case of Germany, it can destroy an economy. And in our case, it took us a very long time to recover from the Great Recession. But we were talking about the Great Recession in the weeks to come as well. Okay? So, all right, so that, again, that covers inflation. I'll just put this last board up because that's what we're going to be going into. The market for loanable funds, okay? And we start looking at financing and the market for loanable funds. What is that about? Well, again, the market for loanable funds is like any other market, basically. When we talk about the market for apples or wheat, what a market is doing is bringing the buyers and the sellers together, okay? And when we talk about loanable funds, the goods aren't apples or wheat. It's what it tells you it is. It's loanable funds. It's money, all right? That is the good. It's money. And we're bringing the buyers and the sellers of money together. And the price they pay or receive for that money is the interest rate. So the interest rate is the price of money, and the market for loanable funds brings the buyers and the sellers of money together. Now the sellers of money would be you and I when we, let's say we're putting money in our savings account, okay, at a commercial bank. Commercial banks typically are the banks that you and I would think of. Bank of America we go to, we open up a checking or savings account. When we put money into our savings account, we are, in a sense, selling our money to the bank. And the interest, although it's not much, the interest that the bank is paying us is the price of the money. That's what we're selling the money for. Now, the buyers of money are our borrowers, all right? And they are buying the money from the bank. Now, when borrowers do this, go to a bank to borrow funds, all right, we call that indirect financing because they're not going directly to you and I to borrow the money, all right? So that's indirect financing. We have the lenders and the borrowers. They use the bank as an intermediary, okay? So we see there's commercial banks, investment banks, which would be involved with large corporations setting up a bond issue, so on and so forth, mutual funds, stock exchanges. The whole idea is we're bringing the buyers and the sellers of money together. Now, again, I'm not going to go into this too much today, but because we're going to go into it quite a bit in our next session. I just wanted to mention this. Direct financing is when the borrowers go directly to you and I for the funds. And typically, direct financing would be the bond market, where a bond is an IOU, and they will go directly to the people who are, the people who are buying the bonds are basically lending the money to the firms that are issuing the bonds. Now, they'll use an investment bank to handle that transaction, but specifically, they're not borrowing money from the investment bank. They are borrowing money from you and I. Just like the stock exchange also would be a type of direct financing. Now, stocks are different from bonds, and we're going to go into this in more detail next time, but stocks are not debt instruments, okay? They are what they call equity instruments. Stocks are partial ownership of a company. And again, companies can raise a lot of money selling stock or selling bonds. If they're looking to borrow perhaps just a smaller amount of money, they may use their bank that they have, typically, take out a loan for maybe an expansion on their shipping or receiving docks. They may take a loan out, and that is indirect financing. But direct financing would be either through bonds or stocks. Okay? All right, that's it for now. Everybody keep up the good work, and we will definitely see you next time.